Assalamualaikum and good day to Dr. Abdul Aziz. Today, our group will present a research study entitled The Impact of Green Bond Issuance and ESG Performance on Firm Profitability in Emerging ASEAN Markets. This is our group member, which consists of NURUL Sahira, AHMIE AFYFY, SITI NURUL ATIQAH, AWANGKU WAIZ, MAZIAH ALIAH, and me, NURUL IZZATI INSYIRAH. To begin with, this presentation is divided into 3 chapters. Chapter 1 discusses the background of the study, problem statement, research objective, as well as the scope and limitation. Next, we also have a Chapter 2, which is review the relevant theories and empirical findings. Finally, Chapter 3 explain the research methodology, data sources, and diagnostic check. Let's start with the introduction. In recent years, global concern over climate change and commitment under the Paris Agreement have increased pressure on firms to adopt sustainable financial practices. One notable development is the rise of green bonds, which are debt instruments used to finance environmentally beneficial projects. At the same time, environmental, social, and governance (ESG) performance has become an important benchmark for assessing corporate sustainability and long-term value. However, although green bond issuance and ESG integration have grown rapidly, empirical evidence not their impact on firm profitability remain inconclusive. To address this gap, this study examined publicly listed firms in China, South Korea, and Thailand. Using firm-level panel data, the study investigated whether green bond issuance and ESG performance affect profitability, as measured by return on asset and return on equity. Overall, the findings are relevant as companies continue to face increasing pressure for investors and regulators to adopt sustainable financial strategy. From that, I'll proceed to the next presenter.
Now, I will be presenting the problem statement and the research objective and research questions. Despite the rapid growth of green bonds and ESG adoptions, their impact on firm profitability is still debated. Notably, previous studies have produced mixed results, with some finding positive effects, while others report negative or insignificant relationship between green bond issuance and profitability. Similarly, inconsistencies are also found in studies examining ESG performance and firm profitability. Moreover, most existing studies focus on either green bond issuance or ESG performance, rather than examining their joint effect. In addition, limited research has been conducted in emerging ASEAN markets, where institutional settings and regulatory frameworks differ from developed economies. Furthermore, there are concerns that green bond issuance may function as a signaling or greenwashing mechanism rather than leading to genuine improvement in ESG performance. Taken together, these unresolved issues motivate the need for this study. Based on the problem statement, this study has 4 main objectives. First, it aims to examine the impact of green bond issuance or firm profitability measured by ROA and ROE. Second, it seeks to analyze the effect of ESG performance on firm profitability. Third, the study investigates the joint effect of green bond issuance and ESG performance on firm profitability. Lastly, it assesses whether green bond issuance affects subsequent ESG performance to determine whether green bonds contribute to real sustainability improvement or mainly serve as a signaling mechanism. That's all from me.
This study examines non-financial publicly listed companies in China, South Korea, and Thailand over the period from 2016 to 2022. These countries were selected due to their active involvement in the green bond market and the availability of consistent ESG data. Firm profitability is measured using return on asset (ROA) and return on equity (ROE). Green bond issuance is captured through a time-varying dummy variable, while ESG performance is assessed using definitive ESG scores. Despite its contribution, the study has several limitations. First, the findings may not be fully generalizable beyond the selected countries, as institutional and regulatory environments differ across regions. Second, ESG scores may not entirely reflect firms' actual sustainability practices, as variation in disclosure quality and reporting standards can affect the accuracy of these scores. In addition, measuring green bond issuance as a binary variable does not capture differences in issuance size, frequency, or intensity. The study also relies on accounting-based profitability measures and excludes certain control variables, which may lead to omitted variable bias. The theoretical framework of this study is grounded in three key theories. Signaling theory suggests that issuing green bonds serves as a signal of a firm's commitment to sustainability, potentially enhancing its reputation and stakeholder trust. However, the strength of this signal depends on effective monitoring and enforcement mechanisms. The triple bottom line theory highlights the needs for firms to balance economic, social, and environmental performance, aligning closely with the principle underlying ESG practices. Finally, greenwashing theory provides a critical perspective, explaining how firms may engage in green bond issuance or ESG promotion without delivering meaningful sustainability outcomes, an issue that is particularly relevant in emerging markets where regulatory oversight may be weaker.
Next, I will explain the empirical review of our study. First of all, research on green bonds saw mixed results. On the one hand, some studies find positive impacts such as higher profitability, innovation, and firm value. On the other hand, others report negative or insignificant effects with no clear financial benefit. Similarly, when we look at ESG performance, the findings are also divided. Some studies highlight positive link to profitability, while others show negative or no significant effect. Therefore, the overall evidence is inconsistent, which highlights the need for further investigation, especially in emerging Asian markets. Now, moving on to Chapter 3, Theoretical Framework. This study examines how green bond issuance and ESG performance affect firm profitability in emerging Asian market. Profitability is measured using ROA and ROE, showing how efficiently firms use asset and equity. Green bond issuance is modeled as a dummy variable, 1 in the year of issuance, 0 otherwise, to capture changes before and after issuance. ESG performance is measured using composite ESG score from Refinitiv, covering environmental, social, and governance dimensions. The framework also considers the joint effect of green bonds and ESG on profitability and whether bond issuance influence later ESG performance. Finally, it is guided by signaling theory and greenwashing theory while focusing on observable financial outcome. That's all from me. I will pass to the next presenter.
And now, let's dive into the data sources. This data uses firm-level panel data from publicly listed non-financial companies in China, South Korea, and Thailand, covering the data period from 2016 to 2022. And these countries were selected because they are among the most active green bond issuers in Asia and have relatively comprehensive ESG data availability. All data are obtained from the Refinitiv Icon database, which provides standardized financial statement data, ESG performance scores, and detailed information on corporate bond issuance. And importantly, Refinitiv ESG scores methodology does not directly incorporate green bond issuance, which helps reduce potential endogeneity between the independent variables. And Refinitiv also provides precise bond issuance detail, including bond classification and issuance year, enabling accurate identification of green bond issuer. And this ensures consistency and comparability of profitability and ESG measures across firms and over time. And to examine this relationship, our study employs two specific regression techniques. The first one is difference in differences. BID is a model to isolate the causal effect of green bond issuance. And the second one is random effects model, or REM. It's to analyze ESG impacts and joint effects.
To ensure the reliability of our regression results, we conducted several critical diagnostic checks. First, we examined the multicollinearity using the VIF. Our analysis yielded a mean VIF of 1.33, which is well below the threshold of 10. This confirms that our IV, green bond issuance, and ESG performance are not highly correlated, ensuring that estimates remain stable. Second, we addressed the potential serial correlation and heteroscedasticity common issues in panel data By employing robust standard errors indifference and random effect models, this approach is particularly important for panel data spanning 7 years, as observation from the firm may be correlated over time. Robust standard errors ensures that our p-values remain valid. Finally, regarding the normality of residuals, we rely on the central limit theorem. With a substantial sample size of 1,000 plus firm year observation, our coefficient estimates are asymptomatically valid and reliable, making formal normality tests unnecessary for a sample of this scale. Together, these diagnostic checks confirm that our econometric model are statistically sound and well suited for analyzing sustainable finance in China, South Korea, and Thailand.
In conclusion, this study examines the impact of green bond issuance and ESG performance on firm profitability in emerging Asian market, focusing on non-financial firms in China, South Korea, and Thailand from 2016 to 2022. By integrating signaling theory, triple bottom line theory, and greenwashing theory, the study analyzed both the individual and joint effects of green bond issuance and ESG performance on profitability measured by ROA and ROE. Using robust panel data methods, including difference in differences and random effect model, the study addresses key gaps in existing literature. Overall, this research provides valuable insight for firms, investors, and policymakers by highlighting whether sustainability finance initiatives contribute to real financial performance and genuine sustainability outcomes. Thank you.